Hello and welcome to BQ Prime. You're watching IPO Adda, and my guest today is from Uniparts India. The IPO coming out on November 30th. Uh, Uniparts is the manufacturer of off-highway equipment and solutions. The company is coming out with an offer for sale through an IPO of 1.44 crore shares, priced between 548 to 575. It The value of the company comes to nearly 2,600 crores at the upper end of the price band. And joining me is Gurdeep Soni, who is the chairman and managing director of the company. Uh, Mr. Soni, thank you very much for joining us on IPO on BQ Prime. Uh, to begin with, sir, give us a brief of what is the kind of business model that you have, and to get an understanding of the kind of equipment and manufacturing that you do.
Thank you very much giving me this opportunity to present my company. As you mentioned, we are not on highway, we are off highway, which means we are in the industry of uh, agricultural machinery parts and construction machinery parts. We are a global solution provider to this industry. And more specifically, when I talk about the agricultural machinery, I'm talking about what is known as a three-point linkage system that is behind a tractor. This is used by the farmer to hitch his implement to the tractor. The three-point linkage is an integral part of the tractor, and the OEMs, when they roll off the tractor from the assembly line and sell to the farmer, it comes with the three-point linkage system. We are a global player in this market. We have a global market share of 16.68% in this market. And the fact is that out of the top 10 uh, agricultural machinery manufacturers globally, all top 10 are my customers, including the largest one. We also, most of our business is exports. It's over 80% of what we do is exports. Only about 15% is in the Indian market. And that, in a nutshell, is what we do on the agricultural machinery side. Coming to the construction machinery side, we do what is known as articulated joints. Now, these are joints that are on every construction machinery, on the arm of every construction machinery, like the front loaders, skid steers, excavators, and are very precision parts. This is a kind of a fragmented market, but on a global scale, we have a market share of 5.92% over here as well. And in terms of customers, out of the top 10 in the world outside of China, because we don't do any business with China. So out of the top 10 globally outside of China, 5 are my customers, including the largest company in the world. Uh,
Mhm.
let me brief
So,
that
uh,
one.
so, you're coming with the offer for sale where the promoter shareholders and some selling shareholders are selling. Um, you are a company that requires a lot of inventory backup as well as requirement of working capital. Why haven't you looked at raising for fresh capital?
Um, I just want to let you know that our selling model is exports from India, and more importantly, selling from our warehouses that we have globally. In fact, we have two warehouses in USA and one in Germany and Europe, and and this is a complete risk-free supply chain sort of a model that is very much appreciated by all our customers. This model does require inventory, but the cost of inventory is part of the business, and and so the customers really appreciate this because we have taken the complete risk out of the supply chain in the supplies of the parts that we supply to them.
No, I get the part of the supply chain part of it. I'm looking from the finance point of view. Does the company require fresh capital to augment its working capital requirements? And because you have a very high inventory based supply chain, your capital gets stuck till those inventories are offloaded.
So we are a very strong financial company. Our financials are very strong, and so the part of the inventory being the number of days it is part of the business. It's an end business that is giving us very strong numbers. In fact, our our EBITDA is about 22%, and our margins are 14%, and our ROC is about 31%, and ROE is 27%. So we have but what we do is having higher inventory is part of our business, and that's a part of the model that is generating us this very strong financial numbers, which is the reason
Mhm.
the company doesn't need any fresh money, because it's generating a lot of cash. In fact, we even have a 25% stated dividend policy, which we are because of the good cash generation from the company, we are able to do.
And that dividend policy will continue post IPO as well.
Yes, this is a dividend policy that we have stated, and it will continue.
So this is 25% of the net profit or cash from operations.
So it's basically I look at three numbers. I look at 22% as an EBITDA margin company, 14% as a PAT number, and 7% as free cash. So the free cash that we have is after taking care of requirements of a working capital and for capex. And the free cash, which is 7%, 50% of the free cash is going to be distributed as a dividend, and the balance is really ammunition for future acquisitions that the company may do. And therefore, the company has enough funds to for its growing needs.
Hmm. Mr. Soni, I was looking at your cash flows as well. While you are positive on the operating cash flows, on the investing and financing cash flows, it's been negative for last couple of years. What is the kind of investments that are required going forward from your end? And uh, finance from a financing point of view, how are you? You're majorly into short-term loans and current loans. So will that be reducing going forward as you manage your inventory?
Correct. So the way we look at our business model is that out of the 14% PAT we are generating and the cash flow that we are generating, 7% will be used for working capital and for capex. So a capex is a very low, amount that we need. It's only about 3% of my top line. The reason is that we are not an automotive, like I said, and we don't set up line manufacturing. What we set up is discrete manufacturing, and also our model does not include land and building because that we lease out. So really investing in land and building doesn't give us the return that we get out of the business itself. And
Mm.
so all this cash flow is taking care of all our requirements as we plan for our future growth.
Mm-hmm. In the RHP, you had mentioned that you expect proportion of the warehouse sales to increase compared to direct exports and local deliveries. Why do you say so?
Good question. My what I call as local delivery is made in India and sell in India, which is only about 13% of my business. We also have a manufacturing location in USA, and what we make in USA and sell in the USA, also what I call as local deliveries, is about 13% of my business. My exports directly out of India are about 26% of my business, and currently my sales from my warehouse are 41% of the total business. This used to be 31% about 5 years ago, and over the years this has gone up. The customers that we service, they really look forward to this supplies from the warehouse model because it is completely risk free. We carry 2 months of inventory in our warehouses. We have about 2.5 months of inventory on water, as we say. In fact, during the COVID time, this model was tested so well that when India was closed for about 2 months, we were able to keep our supplies to all our customers simply because of the inventory we had in the warehouses and on water. Uh,
Mhm.
and because of this, we are in fact the new businesses that we are attracting from our existing customers and some new ones as well is primarily because we offer risk-free delivery to them. Um, so that's why this is a preferred model.
You know, there You have your a lot of your business coming in from US and Europe, nearly 75%, if I'm not wrong, 74 3 to 75% coming in from these two regions. And now we are hearing about a slowdown which is coming in these regions. We are talking of expected recession in the US. Europe has its own issues with gas and others, which may bring down industrial activity, or bring down the industrial activity. Uh, your business is very directly linked to those economic activities, and how do you plan to hedge yourself against those kind of headwinds which are coming in?
Correct. So while we are looking at high interest rates leading to potential slowdown in those countries, but truly my model is only selling to the agricultural machinery and the construction machinery part of the world. Both of these are in fact going through some of the best period in their life. Let me tell you some of the key reasons why this is happening. Last year, the USA announced a $1 trillion infrastructure bill to spend on the infrastructure in USA. That is giving a great boost to the requirement of equipment for building infrastructure. The oil and gas prices are high, and so a lot of infrastructure build is happening over there. And to some extent, we are seeing a lot more disasters happening, like hurricanes and all that. But truly, that is leading to a lot of rebuilding. That is leading to that. So clearly, and even if you look at the commentary from the largest producer of construction machinery in the world, they are in fact projecting a fantastic growth next year, and in fact, they think the peak is almost till 2026, in their business. The second thing I want to mention here is the China plus one. This is really bringing in a lot of business to companies like us. We are actually seeing some of the people, our customers that were buying from China, are seriously moving product and placing new businesses to us. India is being really pushed towards what somebody is now mentioned as friend shoring. They want to buy from countries that are friendly, and we are a great recipient of that. Um, Again, on the agricultural side, we've seen the Russian and the Ukraine war that actually a lot of exportable grain got out of the market, and that really led to prices of food grains and other food products going up. In fact, the Indian farmers wanted to make a lot of exports, but thankfully the government decided that they would not let exports happen and control prices in India. But what has happened in USA and Europe is that the farmer is very rich. They are actually making the most money they have made in the last 6 years. Plus the fact that during the COVID time, the the inventories were depleted from all the dealerships, and there is hardly any inventory for these machineries. In fact, our main customers tell us that there's a wait list of 3 to 6 months even today for the machinery that they are making. So we do not see effect, particularly in the agriculture and the construction businesses in both USA and Europe.
But sir, while you say paint a rosy picture, you yourself has have warned about the slowdown in the position and the construction equipment business, growing at 6 to 8% compared to a CAGR of 15% in the past 5 years. So do you see that having some kind of slowdown impact on you, or you see there are other avenues which are emerging because of the geopolitical reasons, or for that matter the heightened spending by governments across some of the regions, that will compensate for that growth?
So absolutely, if you look at the CRISIL report, they are projecting both these industries to grow between 7 to 7.5%, and I'm talking about our product groups. But really, like I mentioned, that with the China plus one and the spend on infrastructure, we are looking at more additional business coming to us, not only from the large customers that we have, but even new customers that are now we are moving towards. And that's the strength of the company of attracting more business. So we actually intend to grow far more than how the industry is going to be growing. In fact, even in the last 6 years, whereas the growth of the industry has been average 5%, our own business has grown 12.1% in the last 6 years. And Our EBITDA, in fact, has grown on a CAGR of 30% and PAT on 40% in the last 6 years.
Two of your subsidiaries, which is UUL and UOL, are are in the center of your business because they account for nearly 41% of your revenues, if I'm not wrong. Uh, do these subsidies require capitalization because there could be loss making?
So, first of all, I have two warehouses in USA. This is under the name of Uniparts USA, which is usual that you mentioned. And we have UIG, which is our warehouse in Germany. These are warehouse models. And these warehouse models, are on rented premises. They don't have any plant and equipment over there. So they are very low cost models for us to operate. And in fact, we treat our warehouses as profit centers. So we make profit in India when we sell to them, but we also make profit over there through the warehouse models. We do have a manufacturing facility in USA in a place called Elridge in Iowa, and that is giving 13% of the top line of our business. And even that is at a very healthy 12.5% EBITDA margin. So overall, 41% is through the warehouses, and 13% is made in USA and sold in USA. And all
Mhm.
profitable. They are all subsidiaries of Uniparts India Limited. So all the profits that are made are coming into one balance sheet, which is Uniparts India Limited.
Okay. You spoke about the China model and the China Plus model, but you are dependent on China for some of the supplies, if I'm not wrong, seamless tubes and others. Have you been able to get alternate sourcing for them for these kind of supplies?
So, the total steel consumption is about 5,000 tons a month in my operations in India. Out of that 5,000 tons, actually the tubing is only 200 tons. So my dependence on China, and again, out of those 200 tons, only about 150 tons come from China and the rest from within India. So the tubing is really a small amount. And then I have units set up in two of my units are in SEZs, and so we bring them free of duty from China. But we have alternative sources in India. We just buy it wherever it is the cheapest to buy. So it's not that we will be dependent on China, and if anything happens, then we will not be at any loss.
Mhm. What about the strategy for Asia Pac and Japan area? Because though you have some operations there, it's pretty small in terms of your revenue contribution. And I think you are looking to diversify your business in that region as well.
Correct. So, in fact, you mentioned about the percentage of the businesses that we have in US and Europe, but Japan is also close to 5% now. Our business is actually where the machinery is manufactured and not where it's used. So, even though there's farming in Asia in general, but the manufacturing doesn't happen of the equipment. The manufacturing is happening primarily in Europe, USA, India, Japan. So the markets are really where the equipment is being manufactured and not where it is used. And yes,
Okay.
these Asia Pacific is serviced, but by our customers who are supplying to them.
Okay. Uh, you told us that, in the beginning of the interview that you normally keep inventories of nearly 2 months, 60 days.
Correct.
Uh, if I look at your numbers, your inventory days for Q1 was around 122, and for FY22 it was 131. Any particular reason why these were high?
So, like I mentioned, we do have 2 months of inventory not only in our warehouses, but we also have another 2.5 months, which is I call inventory on water, which is parts that are ready. They ship out of my factory, and by the time they reach my warehouses, it's an average 2.5 months. But that is
Hmm.
part of the business model, and really, like I mentioned, it takes the risk out of supply chain completely for the customers, and the customers really prefer this uh, because despite selling them through the warehouses, we are still over 20% cheaper than what they would be if they buy from parts made within their countries. India being the only one in our business in a low cost country versus Europe and USA.
So it takes 2 months to ship out from India to and reach your warehouse. That's what you're saying?
Correct. So, the shipping time before the COVID was actually from my warehouse to from my factories to my warehouse is about 55 days to USA and 45 days to Europe. Um, Post the COVID, when all the crisis happened on the supply chain, this number actually went up to 90 days. It's currently down to 65 days, and it's improving. So yes, this is part of the business model. And but let me tell you that because we are a cash rich company, my debt, in fact, which was 4 years ago close to 250 crores, on 31st March, it was actually down to 100 crores. And as we speak, it is much below that as well. Our cost of debt is also very low. We borrow in dollars for all my requirements of working capital. And last year, my average interest cost was only 2.11%. In the first 6 months, it's 3.35%. And moving forward, it'll only be in the region of 5, as the interest rates are moving up.
Mm. And since majority of your revenues are overseas, your most of the borrowings would be overseas.
Most of the borrowings are in India, but in US dollars.
Okay.
Manufacturing is in US, is in India. Only 13% of my manufacturing is in USA and 87% is in India. And so the money really required for working capital is in India.
What is the kind of working capital requirement that you need, Mr. Soni? I mean, and how do you manage that kind of thing? Because that's something which is more dependent on the kind of inventories that you want to keep, right?
Correct. So actually, the total working capital cycle is about 150 days, and like you correctly mentioned, it's 120 days of inventory. We have 55 days of accounts receivables and 25 days of accounts payable. So net off is 30. So that 120 plus 30 makes it 150 days.
Okay. So, and that will continue to be the same thing because where I'm coming from is from a point of view forecasting of how you can look at the demand because you are directly linked to economic activity of any country where it is happening, whether it's agriculture or construction or mining or forestry, wherever it is. Uh, is there a way of a better forecasting that you could do and look at how you can, reduce your cost or working capital requirement?
Absolutely. So, as far as the inventory days are concerned, we don't see anything coming that's over there because of the selling model that we have. But clearly, it's a very dynamic thing with the accounts payables and receivables where we are trying to reduce the total number of days of working capital. But let me tell you about the demand in the countries of USA and Europe and Japan. Because we are dealing with very large corporations, we are actually linked to through EDI, electronic data phase, into their systems. We do close to 12,000 part numbers, and for each part number, we actually get a forecast for 12 to 18 months. And that also tells us how they are forecasting their business to move. But we are using those forecasts to really plan our orders from our warehouses into our factories, because my warehouse must know what it's going to sell 6 months from today and place that order in India. I need about 90 days to manufacture, and like I said, about 2.5 months on water. So clearly, 6 months of future looking is used by the warehouses to plan the orders on us, and these numbers are coming directly from our customers' databases.
So it makes little life little easier in estimating what kind of revenues that you could do in coming 6 months, is it?
Correct. So there are two sources of revenue. One is the existing business, which I said the forecasting model allows us to look into where the demand is. And the second, of course, like I said, that we are attracting new business from the existing customers and some new customers simply because of this China one policy and the friend shoring that is the US is talking about. So there's a lot more new business coming to us. In fact, even you mentioned the energy crisis in Europe. Fact is that that is actually pushing or making a lot of manufacturers in Europe look at India as a source of supply of parts, simply because India is therefore a cheaper alternative and a short insurance that they will get the parts through the warehousing system.
Hmm. Since 70 or 70, if I'm not on 77% or something of your revenues coming from OEMs, what is the kind of order book you're sitting on?
So, like I said, okay, my aftermarket is 17%, my OEM is 83%. My business in India is only about 13.5%. The rest is from overseas. And uh, the way this system works is it's not that they issue physical orders. They, like I mentioned, they just give us a forecast and we manufacture to the forecast, and then they have a pulling system or they place the orders based on just-in-time requirements. So that's the way.
Okay.
And because we have the inventories, we use any fluctuations in demand are adjusted from the inventories.
How do you manage the raw material cost? Because that has been going up, and you've been sourcing your key raw material steel from spot markets where you don't have long-term agreements. So how do you manage that kind of cost? Because there is now this inventory gap which comes in. So if the cycle is on a high, you are sitting on a high cost inventory. But by the time you're selling it, the prices may have come down.
Absolutely, absolutely. So with all my customers, we have actually four agreements in place. One of them is to cover steel. So any steel price going up and down is a complete pass-through entity. It comes with a 3-month lag. So, for example, what the steel price would have been in Jan, Feb, March of this year, we will negotiate in April, and from May or 1st June, we will implement a new price. So it comes with about a 3-month lag. And as it goes up, so we are well covered. As it is coming off a little bit, we have to return as well. But that doesn't affect my bottom line because that's a straight pass-through entity. The second agreement that we have with our customers is through freight. Freight, which to USA used to be a little over $2,000 a container, actually went up to almost $15,000 a container. It is now down to about 6,000. But again, freight is a complete pass-through entity. Every month, we raise a bill to the most of our customers about the extra freight we paid, and they just pay us as a supplementary charge. The third thing is obsolescence. Because we carry so much inventory, we have an agreement that if a machine is getting phased out and they want to stop buying parts for it, they will pick up at minimum 6 months of the inventory we have. Of course, they don't decide that they're going to stop a machine manufactured tomorrow. They may give us a time of 3 to 4 months or even 5 months, but with us, we have agreements of 6 months to take care of all inventory that we be holding. So we are not hit by that also. And the fourth one is on the foreign exchange. Foreign exchange till about 4 years ago, we used to pass on the gains on the depreciation of the rupee. But 4 years ago, we told our customers that, listen, if you look at the delta between inflation in India and the US, India was typically 6% and USA 2%. It was about 4% for a 10-year period. And the depreciation of the rupee to the US dollar has also been about 3.8% for over a 10-year period. So we said, either you give us inflation in India or you do away with taking the benefit of a depreciation currency. Majority of our customers have agreed to do away with taking the benefit of a depreciating rupee. So that is the fourth agreement, and so this is the way we are handling our business the way it is, and giving us very strong financial results.
It seems that you have well ring fenced your entire operations from all the headwinds.
Correct. We have been in this business for actually since 1984, and even though the company was made in 1994, but from 1984 till the year 2000, we were just an export company. So we know these markets very well. In fact, we sold for the first time in India in the year 2000. That's the year when companies like John Deere and Case New Holland set up tractor plants in India, and that was our first foray into India. And India still continues to be only about a little over 13.5% of a market. But export is where our bread and butter is. We understand the market, we understand the people. More importantly, it's a wavelength with the customers. We have a wavelength, we have a partner status, as they call them, and that really works very beautifully for us and for them.
Mr. Soni, it was a pleasure talking to you today. Uniparts India IPO is opening on November 30th and closes on December 2nd. Price between 548 to 557. It's an OFS of 1.44 crore shares where selling promoters and some of the selling shareholders are going to offload shares, uh, valuing the company at nearly 2,600 crores at the upper end of the price band. Thank you for watching BQ Prime.